For years, Indian IT was one of the easiest stories to believe. The companies were large, cash-rich, globally respected, and deeply tied to India's rise. But in 2026, that confidence somewhat cracked. Since TCS kicked off earnings in April 2026, nearly $115 billion has been wiped off the value of India's IT gauge, with the Nifty IT Index down about 31% in the first half of 2026. It's been the worst start to a year since 2003. If you only look at the stock price, the conclusion feels almost obvious. But if you zoom out, the picture is much more interesting and much more important for Indian investors. India's tech industry is generating close to $283 billion in annual revenue, with about $224 billion coming from exports in FY 2025. This is clearly a large, growing industry, not one in the decline. An industry currently being repriced because the market is figuring out how AI impacts its business model. So this video is not one about a crazy prediction or a scary headline. It's about the direction of the Indian IT, what the data actually says, and how to think about the sector if you own Indian equities, mutual funds, or even work in the industry yourself. By the end, as always, you will have a framework that will help you decode what is genuinely under threat, what is merely being repriced, and what kind of IT company is most likely to survive this AI transition. Let's start with the uncomfortable truth. Indian IT stocks have been derated and derated hard. And the trigger for the latest round of fear came from outside of India. Accenture, the world's largest listed IT services company that cut its full-year local currency revenue growth guidance to 3 to 4% from 3 to 5%, and even warned on demand softness. That doesn't sound like much of a revision, but its stock fell sharply after that result. And that warning rippled straight into Indian IT valuations. The market's logic was simple. If the global benchmark for IT services is seeing weaker bookings and slower client decision-making, Indian firms that sell similar services cannot pretend that they are insulated. And that is why this sell-off matters. It is the market asking whether the old Indian IT formula of more people, more billing, more revenue is still strong enough in a world where AI can automate parts of routine coding, maintenance, testing, and support. For an Indian investor, this is the first key distinction to note. The market is not saying that Indian IT will disappear. It is saying that the old operating model deserves a lower valuation multiple until the new one has proven itself. Now zoom out from the stock chart and look at the industry itself. India's IT business process management (BPM) sector has expanded dramatically over the last decade. Industry estimates showed revenue rising from roughly $167 billion in FY18 to $283 billion in FY 2025. And in 26, estimates are pushing this even higher. The sector's GDP share, for example, has also climbed over time, with several industry trackers placing it around 7 to 8% recently and pointing towards a potential 10% mark in the future. So the sector is not shrinking in absolute terms. Revenue is still growing. Exports are still growing. India is still central to global services supply chain. But the quality of that growth is definitely changing. For years, the business model was brutally simple. Hire thousands of freshers, train them, plug them into large client accounts, and scale through headcount. That model worked because global companies needed armies of engineers to run, maintain, test, and gradually modernize their software stacks. AI does not erase all of that work, but it certainly does threaten the most basic parts of it. Routine tasks can be automated faster, and clients increasingly are expecting vendors to pass those productivity gains back to them. That means the labor arbitrage engine that built the industry in the first place is clearly under threat. So the right question is not, will AI change Indian IT? Of course it will. The real question is, what part of the Indian IT becomes less valuable and what part becomes more valuable? India's strength was never just cheap programmers. Its real strength was implementation and integration at scale. Global enterprises do not just need AI models. They need those models connected to ERP systems, supply chains, call centers, cybersecurity layers, data pipelines, and compliance workflows. In other words, AI needs connectors and process knowledge, something that the Indian IT firms are more than familiar with. What changes is the delivery model. Clients do not want 50-member teams doing manually what a better workflow and a few AI tools can now do faster. They want smaller teams, deeper capability, and more automation and more outcome-based delivery. That is why AI should be seen less as a death sentence. It puts pressure on legacy revenue pools, sure, but it also opens new revenue pools in cloud migration, data engineering, and AI integration. So what does a likely winner in Indian IT sector look like in the present circumstances? First, it looks like an integrator. The companies with the best shot are not the ones shouting AI in every presentation. They are the ones winning work to connect AI into real business systems. Finance, HR, manufacturing, logistics, banking, insurance, and even customer operations. Second, it looks like a reskiller. This is no longer a race to hire the most freshers. It is the race to make existing employees productive in an AI-assisted world. TCS, for example, has said it has trained about 150,000 employees in generative AI skills and has roughly 250 Gen AI-powered projects underway. Third, it looks like a capability buyer. If a company does not have enough digital engineering, AI, or platform talent in-house, it is increasingly choosing to buy that capability through acquisitions rather than wait years to build it organically. The market may not always love those deals in the short term, but strategically, management teams know the next decade will not be won by standing still. Another underappreciated trend is some mid-tier IT firms may actually adapt faster than the giants. Large firms have scale, relationships, and big balance sheets, but they also have baggage, older contracts, which are legacy accounts, slower decision-making, and massive organizational inertia. Mid-tier firms often carry less of that weight. They can pivot faster, go after AI-led transformation work with fewer internal constraints. The acquisition wave reflects this urgency. One of the clearest recent examples is Persistent Systems, an all-cash offer for Germany's Nagaro at 81 euros per share, valuing the target at about 1.27 billion euros or roughly about $1.4 billion. Whether that specific deal creates value is a separate question. The more important signal is what it reveals. Indian IT management teams understand that cloud, data, cybersecurity, digital engineering, and AI are all converging. If they do not own enough of these capabilities already, they are willing to buy them. For investors, this matters because the future leaders may not be companies with the cleanest last quarter. They may be the ones willing to absorb some short-term pain to become more relevant in the AI era. Now bring this home for you and me, the Indian investor. The first mistake is to think that is Indian IT cheap now, so should I buy? That is too basic a question. A lower PE multiple by itself does not make something attractive. Recent market data suggests the Nifty IT Index is trading on a trailing PE of around 19x, well below the 25 to 35 multiple it commanded in the pandemic era cloud boom years. So here is the better scorecard to follow. Be cautious about those companies whose pitch sounds like an old labor arbitrage story. More people, lower cost, same old delivery. Firms overly dependent on basic maintenance or support work without a visible AI transition strategy. Stocks that look optically cheap only because the market expects their earnings quality to worsen. Watch more closely for companies winning integration-led or modernization-led deals, not just cost takeout or cost arbitrage work. Management teams investing heavily in reskilling and tooling while being realistic about hiring. Firms that use acquisitions or partnerships to build missing AI, data, cybersecurity capabilities. Businesses linked to the infrastructure side of AI build-out, especially cloud, data center architecture, and enterprise tech plumbing. This last point matters because the infrastructure tailwind is real. IBEF notes that India has already attracted $14.6 billion in data center investment since 2020, and that could see another $25 billion by 2030, while installed capacity is projected to cross 4,500 megawatts by 2030. That does not mean every IT stock wins. It means the backdrop of AI-linked infrastructure and enterprise modernization is stronger than what the stock is currently suggesting. Every technology transition produces the same headline. This time the incumbents are finished. The cloud transition produced that headline, SaaS produced that headline, AI is producing it again. Sometimes the market is right about the pain. The transition is of course real. Legacy work will be squeezed. Margins will come under pressure. But repriced is not the same thing as broken. India still has scale, it has process capability, it still has global client relationships. The old promise of Indian IT was we will run your systems cheaply. The new promise has to become we will help reinvent your systems for an AI-driven world. The investors who understand that difference will stop asking whether Indian IT is dead and start asking the better question. Which companies are actually building the next version of it? And those are the ones who will be making the right stock moves. On DeKoder, that's what we keep coming back to. The quiet shifts in business models that decide who actually wins the next decade. If you want more data-driven breakdowns like this, hit subscribe, share this with someone who's still only looking at price charts, and tell us in the comments which Indian IT name you think is genuinely building for an AI-first world. Until next time, invest not just with conviction, but with clarity. See you soon.